Everybody has been talking about how the dollar has been crashing this year.
The dollar, as an example, has been dropping compared to several other currencies since mid-January, declining to the lowest level in 3 years.
The worst decline in the first half of the year since 1973. So this begs the question, have we entered the end game for the dollar? How far down will it actually go? Is this the beginning of what the people in the gold space and the Bitcoin space have been warning us about with the absolute collapse, or crash, whichever word you prefer, of the United States dollar? I'm going to answer that question for you in 3 simple, fast steps. Step number 1, let's go over this huge move in the dollar. We'll use the DXY as a proxy. This chart, today's date, going all the way back to 2025 on the left, we go from 0 up here, up to 2%, but then all the way down to a negative 10%. So we start off the year right around 0, fluctuates back and forth, but then it really starts its decline here in Q1, and then Trump comes out with the tariffs, the Liberation Day, if you will, and the dollar goes straight down. Now, this could have been the result of many things. Maybe foreigners were dumping dollars because they hate Trump, or they're mad at those tariffs, or they just didn't trust the United States anymore. Maybe a lot of those foreigners were also selling dollars because they didn't have a choice. Regardless of the reason, the dollar did go down on the DXY. But then what you'd expect is the dollar to snap back, which it did. Why would we expect this? Well, this is really a topic for a separate video, but most of the dollars outside of the United States are lent into existence. So you always have an inelastic demand for the dollar. Now, that doesn't represent the total demand, but a percentage, a substantial percentage of the demand for dollars, especially outside of the United States, is inelastic. So we did have that snapback, but since that time, the dollar has continued on this downward trajectory where, like we said at the beginning of the video, the dollar has had its biggest decline since 1973. So to answer the question, is this the end for the dollar and how far down will the dollar actually go? We have to understand why the dollar has gone down. Not necessarily during this time frame. That's pretty obvious. Thank you, Donald Trump. But more so this time frame, recently, in the last month. Why on earth did we snap back to 101 or 102 and then go right down to where we are today, where the dollar has been trading right around a 96 handle? We're going to get into that right now. And oh, by the way, at the end of this video, I'm going to reveal how I'm positioning my own portfolio based on the signals that we're getting from this extreme move in the United States dollar. Step number 2. Now let's talk about something called interest rate differentials. This may seem a little confusing, but it's actually very straightforward. We look at a chart going back to January of 2003. Now, what I want you to focus on is the blue line and the black line. The blue line represents the federal funds rate, so the overnight rate the Fed sets, and the black line is the ECB equivalent. Now, the reason I'm focusing on the Fed and the ECB is because when we look at the DXY, which is what most people use as a proxy for the strength or the weakness of the dollar, it's comprised of a basket of currencies versus the dollar. But 57% of the basket is euro. So if we want to understand these concepts and what's probably driving the DXY lower, we've got to start by addressing, okay, what's going on with the Federal Reserve and the ECB. Okay, so you'll see in 2006, 2007, 2008, just prior to the GFC, this is when the Fed started dropping rates, but the ECB had things on pause. Okay, then what happened when the stuff really hit the fan is the Fed took rates all the way down to 0. You guys remember this. But the ECB stopped right around, call it 1%. Okay, now let's fast forward to 2011, 2012. Notice what's happening here. The ECB is increasing interest rates. The Fed keeping things at rock bottom, 0. And then once we get to 2015-16, you see the exact opposite. You see the Fed raising rates and the ECB pegging them to the floor. Now let's go ahead and look at the same time frames in the chart of the DXY. So after the GFC, and remember this is when the ECB was raising rates just slightly, the dollar got all the way down to under 75. But then what happened when we fast forward to 2015-16 when the Fed started raising rates, and I believe at that time the ECB might have even been negative, but there's no way they're higher than zero. That's for sure. But what happened? The dollar appreciated substantially, taking us to the range where we have been for about the last, call it 10 years, trading between 90 and 110. So what's happening here are these interest rate differentials are changing. And that's just saying the difference between the ECB's interest rate and the Fed's interest rate. So if the ECB is hiking rates and the Fed is keeping them the same, then this provides a tailwind to the euro, and vice versa. If the Fed is hiking rates or paused and the ECB is cutting rates, then this gives a tailwind to the US dollar. Now, let me be very clear before we move on. These interest rate differentials aren't the only thing that impact the dollar. There's thousands of variables. But this is a very strong cross-current we have to pay attention to. Now, the mechanics of the monetary system at the end of the day, I think, are the overriding factor. But 6-month period, year period, during these shorter time frames, you can have significant moves between the two currencies simply as a result of these interest rate differentials, although over the long run, they really don't make that much of a difference. So now let's fast forward to 2025 and think about what is happening right now, or what has happened in the last, let's say, month or so. So if we go back to when the dollar was at 101, the idea back then is that the Fed was going to remain hawkish. And during this time, the ECB was cutting rates. So if anything, that spread was increasing, which would be a headwind for the euro and a tailwind for the dollar. So my point there is that 101 price included a hawkish Fed and included a dovish ECB. But then what we've seen over the last month is the data, the economic data in the United States has started to trend weaker, let's say, to the point where yesterday the ADP number was a negative 33,000, a huge miss considering the market was expecting a positive 100,000. Now today we did get rosier employment data that exceeded expectations, but the overall numbers are still quite poor. Doesn't necessarily mean that you're in the depths of a recession, but what it does mean is the economy is kind of teetering on the edge, and it's really not strong and resilient like the mainstream media would lead you to believe. So as the data gets softer and weaker, the expectations for the Fed cutting rates and therefore reducing the interest rate differential increases. Let me show you what I'm talking about. Let's go over to Fed Watch. And currently the odds of the Fed cutting in the next meeting, 4.7%. That's because we got higher than expected job numbers today. But look where we were just yesterday. It was at 23%. And going back a month, right around 23%. So what you're seeing there are the odds of the Fed dropping increasing, which means the odds of the interest rate differential decreasing, which is going to be a headwind for the dollar. I think this really explains the extreme move down that you've seen over the past month, which has led to the worst first half of a year for the dollar since 1973. Step number 3. So now we go into trying to answer the question, how low will the DXY or the dollar go? And is this the beginning of the end for the king dollar and possibly the end of the dollar's reign as the global reserve currency? Let's start by looking at a chart. Now this is the same DXY chart, but a little bit different time frame. We go from today's date all the way back to 2005. On the left, we go from 70 up to 110. Now you guys know where we started from step number 1 and step number 2. 2005, right around 90, we go way down here at the beginning of the GFC, then go right back up because everyone sees the dollar as a safe haven asset. And then we had that interest rate differential. Fed really drops, ECB not so much. And then they go up to, what was it, 1.5%? But this is the first red arrow I want to highlight where we got pretty darn low here, let's say 75. So the dollar depreciated from 2005 to 2011. But then we had those interest rate differentials reverse and dollar rips higher up to 100. Now, what I want to point out with this arrow, and this arrow is over the last 10 years, we've kind of traded in this range. I think we might have talked about that in step number 1, but I want to highlight it again. Between about 90 and 110. So this was due to the fact that the Fed was usually a lot higher than the ECB. And therefore, just looking at this strictly through the lens of those interest rate differentials, you have to assume that we would likely stay in this range between 90 and 110, assuming the Fed continues to be higher than the ECB. But I'm sure a lot of you right about now are asking the question, okay, George, well, that's fine and dandy, but what if the Fed actually goes lower, really drops rates, and their rates go below the ECB like we saw back here? Couldn't the dollar go a lot lower than 90? Well, if that happens, then yes. But we have to think through how that would happen. So why would the Fed take rates straight back to zero? Well, you say, George, because we go through a GFC or a big recession or something like the cerveza sickness or even a balance sheet recession like we saw in 2001. Okay, fair enough, but if the United States goes into a recession, what do you think is going to happen to Europe? Because all the problems with the United States, if you want to look at the deficits, the debt, the government spending, the misallocation of resources, the malinvestment, all of these bad things, it's true. We see that in the United States, but holy cow, it's 10x worse in Europe. And by the way, the one great thing about the US economy is it is still incredibly dynamic. We have innovation. And again, in places like Europe, not so much. So the probability of the Fed dropping down to zero and the ECB not dropping down to zero because things are way worse there, I think is extremely low. So to answer the question to the best of my abilities, and again, we're not talking about certainties, only probabilities, is this the dollar endgame? Absolutely not. Because although the dollar isn't going to be the world reserve currency forever, in order for it to not be the global reserve currency, the monetary system has to fundamentally change. And just because we have a BRICS currency potentially, or a gold-backed currency, or because foreigners are dumping treasuries, this does not change the structure of the monetary system. As an example, what would change the structure of a monetary system is a wholesale central bank digital currency, but that's a topic for a separate video. And until we get to that point, I think the Fed is going to likely be higher than the ECB. So to answer this question, or just give you my base case, the low on the DXY, probably around 90. I wouldn't be surprised if it gets into the 80s, but if I had to put money on it, I think this support level would hold up. So then the big question becomes, okay, George, well, I get what you're saying here, but how should I set up my portfolio? I mean, what should I do based on these signals that you're talking about in the DXY? And if you guys remember at the beginning of the video, I gave you a little teaser there that I would tell you how you can get access to, or I'd reveal what I'm doing in my own personal portfolio to not just survive this action, but to actually profit from it. I call the video the dollar playbook, and it's how George Gammon is trying to profit from these big extreme moves that we see in the dollar that we haven't seen since 1973. And you can get access to this free of charge just by clicking on the link in the description of the video or the link in the pinned comment. I'm going to go over step by step how I'm putting on what I think is an asymmetric trade to take advantage of everything we discussed in this video. And I'm going to go over the charts and the historical data to back up my position. This dollar playbook is definitely something that you're going to want to check out. And again, you can get it free of charge just by clicking on the link in the description of this video.